All right, stop scrolling for a second because something real is happening right now in silver, and it's not subtle. We've got spot silver hovering around $81, $82 an ounce as I'm speaking, still down roughly 33% from last week's blow-off peak at 121.64. And tonight, after the close, the CME is hiking silver margin requirements by about 36%. That just went live. That means today's trading isn't just another red day, it's a deadline. Stay with me, because I'm going to show you why this move matters, how this pattern repeats, and what you should be watching into the close if you want to stay ahead of the crowd. Now, before I explain what caused this, let me teach you something most people never really learn about markets. Price doesn't always move because people suddenly hate an asset. Sometimes price moves because the plumbing gets tighter. Think of leverage like oxygen in a room. When there's plenty of it, everyone's calm. When it gets restricted suddenly, people start panicking, not because the building's on fire, but because they can't breathe. Margin requirements are exactly that. They decide how much oxygen leveraged traders get. When margins rise, the room doesn't change, but the air gets thinner fast. And most people watching a chart don't see that part at all, do they? So what does that tell us? It tells us that when you see violent moves on heavy volume into a margin deadline, you need to ask yourself whether you're watching fundamental selling or mechanical selling. Fundamental selling happens when new information changes the value of an asset. Mechanical selling happens when the structure of the market forces liquidation, regardless of what people actually think about value. And that distinction matters more than anything else right now, because if you confuse the two, you're going to misread what comes next entirely. Here's the thing about mechanical events. They're predictable in pattern, even when you can't predict the exact price. You know how a spring works, right? You compress it, it stores energy, you release it, energy moves. Margin hikes work the same way. They compress liquidity, they force decisions. And when the pressure releases, you get movement that looks chaotic, but actually follows a pretty clear sequence. First, anticipation selling as people front-run the deadline. Then forced liquidation at the deadline itself. Then aftershocks as stops get triggered and weaker positioning unwinds. And finally, after all that energy's been released, stabilization. That's the cycle. And if this is making sense, drop a comment below and let me know where you're watching from, because I want to know who's paying attention to the mechanics and not just the headlines. So here's what's actually happening, and this is important. The CME announces a margin hike of roughly 36% on silver contracts, effective tonight. That means if you're holding a leveraged long position, you've got two choices before the close. You either wire in a lot more cash immediately, or you sell. And when a lot of people are forced to make that decision at the same time, you don't get orderly selling. You get forced liquidation. First, weaker hands sell, then stops get hit. Then margin calls trigger more selling. Liquidity thins out because nobody wants to catch a falling knife into a margin deadline. And price cascades lower, not because demand vanished, but because leverage got squeezed. Now, let me walk you through the exact sequence of events so you understand the cause and effect chain. Silver's been ripping higher for days, speculation's running hot, open interest is elevated. The exchange watches this and sees risk building in the system. They don't want another flash crash or liquidity crisis on their hands, so they do what exchanges always do when things get too hot. They raise margin requirements. It's presented as risk management, and maybe it is. But the timing creates a problem. When you hike margins into an already volatile market, you're not cooling things down gradually. You're slamming the brakes while everyone's going full speed. So, the announcement hits. Traders holding leveraged longs now have to calculate whether they've got enough capital to meet the new requirement. Some do. They wire funds, and they hold. But a lot don't. And those who don't have to sell, not because they changed their mind about silver, but because the rules changed underneath them. That's the primary driver. Forced liquidation from undercapitalized longs who can't meet the new margin. And once that selling starts, it feeds on itself. Algorithms see the price dropping and pull bids. Market makers widen spreads. Liquidity disappears right when you need it most. And the price doesn't fall in a straight line. It gaps, it lurches, it overshoots. But here's the part that should make you nervous if you don't understand mechanics. At the same time this is happening, you've got chatter about large positioning, reports circling about JPMorgan exposure, temporary disruptions at the London Metal Exchange, and even systems issues at HSBC. Now, exchanges and banks deny coordination, and I want to be clear, there's no proof of some smoke-filled room conspiracy. But timing matters. When multiple stress points line up during a margin event, the sell-off accelerates. You've got forced sellers hitting thin liquidity, while big players with better information and deeper pockets can simply step aside. They don't have to sell, they can wait. And here's what validates this interpretation. Look at the volume profile. You see volume spiking on the down moves, not the up moves. That's classic forced liquidation. Look at the intraday patterns. Price holding relatively steady until late in the session, then accelerating lower into the close. That's people racing the margin deadline. Look at volatility. It's exploding higher even as price falls, which tells you this isn't calm distribution. It's panic unwinding. Every data point confirms the same story. This is mechanical, not fundamental. Now here's where it gets interesting, and this is the convergence proof. If this were just a margin hike in isolation, you'd see some selling pressure, sure. But the severity of the move tells you there's more than one force at work. You've got the margin hike forcing immediate decisions. You've got elevated positioning that built up during the rally, creating a crowded long side. You've got reports of institutional exposure that may or may not be true, but create uncertainty either way. And you've got technical breaks of key support levels triggering stop losses. When all of those things happen at once, the result isn't additive, it's multiplicative. Each force amplifies the others. The margin hike triggers forced selling. The forced selling breaks technical support. Breaking support triggers more stops. More stops create more forced selling. And round it goes until leverage is exhausted. Now zoom out with me for a second, because this isn't new. This is the exact same playbook we saw in 2011 when silver spiked, margins were hiked repeatedly, and price collapsed in violent waves before finding any kind of base. Let me set the scene for you. In early 2011, silver went parabolic. It ran from around $30 to nearly $50 in a matter of weeks. Speculation was off the charts. Everyone and their cousin was buying silver. And what did the CME do? They hiked margins, not once, not twice, 5 times in 8 days. Each hike forced more liquidation. Each liquidation pushed price lower. And by the time it was done, silver had collapsed from 50 back down to 33 in a matter of days. Brutal, violent, unforgiving. What happened next? Well, after the leverage was flushed and the weak hands were shaken out, silver eventually found support and stabilized. It didn't recover the highs immediately. It took time. But the fundamental reasons people were buying silver in the first place, those didn't disappear. The margin hikes didn't change the supply and demand picture. They just reset the leverage structure. Same pattern we're seeing today. Or let's go back to March of 2020. Different asset class, but same mechanics. When COVID hit and markets went into free fall, you saw forced liquidation in everything. Even gold, which is supposed to be the safe haven, got sold because people needed to raise cash for margin calls and other positions. The fundamental reason to own gold didn't change. But the mechanical pressure was so intense that nothing was spared. Everything got sold. And once that liquidation wave passed and the leverage was out of the system, what happened? Gold rallied to all-time highs within months. The mechanical sell-off created the opportunity for those who understood what was actually happening. Every time margins rise sharply into elevated volatility, you see brutal closes, aftershocks, and then a period where the market has to relearn how to breathe. When you look at the pattern across decades, across different asset classes, the rhythm is always the same. Parabolic rally, margin hikes, forced liquidation, overshoot to the downside, stabilization, and then eventually, if the fundamentals are still intact, recovery. That's the larger story here. This isn't about silver suddenly losing its role. It's about a mechanical reset. The question isn't whether this pattern will play out. The question is how far the overshoot goes and how long stabilization takes. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a speculative bubble unwinding naturally? Sure, absolutely. Silver ran hard. Maybe it ran too hard too fast. Maybe this is just profit-taking and reality setting in. Could some of the manipulation talk be exaggerated? Yes. Markets love narratives when people are hurting. When you're losing money, it feels better to blame shadowy forces than to admit you got caught on the wrong side of leverage. Could there be legitimate reasons for institutions to reduce exposure that have nothing to do with conspiracy? Of course. Risk management is a real thing. Here's the thing. It doesn't actually matter whether there's intent behind the timing or not. The mechanics are what matter. You don't need a conspiracy to explain forced liquidation. Margin hikes alone are enough. The cause and effect chain works the same whether it's coordinated or coincidental. So instead of arguing about intent, which you can't prove and can't control, focus on what you can actually observe and control. Watch price behavior. Watch volume. Watch volatility. Watch how the market reacts after the margins take effect. That's where the real information is. That's what tells you whether this is exhausting or accelerating, and that's what determines your next move, not some theory about who's pulling strings behind the scenes. There are probably 3 types of people watching this right now. Maybe you're long silver and you're stressed, wondering if you just watched months of gains evaporate. If that's you, I get it. Watching a 33% drawdown in a week is brutal. Your job isn't to predict a bounce today. Your job is survival. Know your leverage, know your margin, and don't let a forced decision get made for you. If you're overextended, de-risk now while you can still make the choice. If you're not overextended, then you have the luxury of patience. But either way, don't confuse a mechanical sell-off with a fundamental breakdown. The metal didn't change, the structure did. Maybe you're on the sidelines, thinking this is all insane and you're waiting for the dust to settle. That's valid. Actually, that's probably the smartest position for a lot of people right now. For you, patience is a position. Let the market show you stability before you act. Let the leverage flush. Let volatility contract. Let the mechanical forces exhaust themselves. There's no prize for catching the exact bottom, especially when the path there is this violent. Wait for confirmation that the worst is over, then make your move with a clear head and a cleaner chart. Or maybe you're a trader looking for opportunity in chaos. If that's you, I respect it. But remember this, volatility after margin hikes is high, but direction is unreliable. You might get a bounce. You might get another leg down. You don't know. What you do know is that trying to predict turns in mechanical sell-offs is a coin flip at best. If you're going to trade this, trade the volatility, not the direction. Use tight stops, size small. Be ready to be wrong. And don't marry a position in an environment like this. The universal rule for all of you is the same. Don't confuse mechanical selling with fundamental failure. If the fundamentals were strong enough to drive silver from 30 to 120, and nothing about those fundamentals has changed except the leverage structure, then what you're watching is a reset, not a reversal. And resets create opportunities if you're patient enough to wait for them. So here's what I want you to answer in the comments. Which type are you? Are you holding through this? Are you waiting on the sidelines? Or are you trying to trade it? And more importantly, what's your plan if this goes lower versus if it stabilizes here? Because that's the question that actually matters. So here's where I stand. I'm not panicking, and I'm not blindly buying either. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether that 80 to 82 zone can hold into the close, because that tells me whether forced selling is exhausting or accelerating. If price can hold there despite the margin pressure, that's your first sign that sellers are running out of ammunition. If it breaks clean through on heavy volume, then we're probably going lower, and the next support zone matters a lot more. Second, I'm watching the 70 to 75 area as a potential final washout if this thing really flushes. Why that zone? Because it roughly corresponds to where silver was trading before the vertical phase of this rally started. It's a logical reversion point if all the speculative froth gets washed out. I'm not saying it has to go there. I'm saying if it does, that's where I'd expect buyers to show up with conviction. Third, I'm watching what volatility does after tonight. If volatility contracts after margins kick in, that's usually your signal the worst is behind us. When leverage is being forced out, volatility spikes. When leverage is gone and the market's in stronger hands, volatility falls. It's that simple. So if we wake up tomorrow and implied volatility is dropping even if price is still weak, that tells me the mechanical phase is ending and we're entering the stabilization phase. Based on my analysis, this move was mechanical, not emotional. The fundamentals didn't disappear overnight. Central banks are still buying gold and silver. Currency debasement is still happening. Inflation concerns are still real. Geopolitical uncertainty is still elevated. Whatever drove people to pile into silver in the first place, those macro factors are still in play. What changed was the leverage structure. The margin hikes forced a reset. And if history rhymes, stabilization comes after the leverage is gone, not before. If history rhymes and silver follows the pattern we saw in 2011 or the pattern we saw in other forced liquidation events, the move that follows stabilization could be substantial. I'm not making a price prediction. I'm saying the setup could be there once the dust settles. But that's future tense. Right now, in present tense, the focus has to be on risk management and watching for signs that the mechanical pressure is relieving. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the margin announcement yourself. Look at the historical precedents yourself. Don't take my word for it or anyone else's word. Make your own informed decisions based on your own risk tolerance and your own financial situation. If you made it this far, you're thinking critically instead of reacting emotionally. That mentality will serve you well, not just in this trade, but in every market you ever touch. The people who survive and thrive in markets aren't the ones who predict every move. They're the ones who understand the mechanics, respect the risk, and stay disciplined when everyone else is panicking. If you found this valuable, share it with someone who needs to hear it. Subscribe if you want more analysis like this when the next major move happens. And stay ahead of the crowd by thinking in patterns, not predictions. Stay sharp out there. Think critically, verify the data, and make your own decisions.